ladies and gentlemen. Welcome to Investment Matters with Peter Kinch and Diversify Alternative Investments. Today, I'm absolutely thrilled to have with me Chess Hagen. Chess is the CEO of AP Capital Mortgage Investment Corporation. That's Mortgage Investment Corporation. The acronym is MIC, AP MIC. And this MIC is a mortgage fund that handles upwards of $140 million of investment capital lent out in mortgages. So, Chess, absolutely thrilled to have you here. Thanks for joining us today.
Thanks, Peter. It's a pleasure. Looking forward to it.
And before we get started, I have to make a note. Chess has recently been appointed the president of the BC MIC Managers Association. So congratulations.
Thanks.
So, okay, so that probably means nothing to most of the listeners. Tell us what is the BC MIC Managers Association and why is that a big deal?
Yeah, I think sometimes it's good to understand the scope of the mortgage industry in Canada. So maybe I can speak to that, and it ultimately leads to answering your question. 75% of the residential mortgage market in Canada is owned by the Big Five, the OSFI regulated Big Five banks. Another 20% is owned by what are often referred to as the monolines, which are reached through mortgage brokers and credit unions. So if you take the credit unions, the monolines, the trust companies, and the big banks, you have 95% of the market for residential mortgage debt in Canada, which is now in excess of $1.5 trillion. The remaining 5% is really held within a audience of mortgage corporations, which I would say mortgage investment corporations, or MICs, are probably the most established going concern operators. So here in British Columbia, the BC MIC Managers Association that you've referenced, that I'm now the elected president of, we encompass 29 or 30 MICs, mortgage investment corporations, all headquartered in BC. And collectively, we manage, I would say, somewhere between $2 and $3 billion. So as a group, we're competitors, but we're also peers. So we're often discussing challenges and situations that are happening in our space. And it's a great group of people that represent really all corners of the province when it comes to mortgage investment corporation lending.
Yeah, no, absolutely. I met the majority of them over the years, and I always find it's fascinating. A lot of people are not familiar with this segment of the market. And I personally, I've been involved in structuring a mortgage investment corp and being involved in a mix. So I understand this in my 25 years of experience working in the mortgage industry. I understand the space very well. I'm comfortable with it. But the average audience listener, the average investor is not really familiar with what this space is. Because when you think of mortgages, well, my mortgage at RBC or my mortgage at Scotia, I'm only paying less than 3% interest rate on my mortgage. So how do you get a better return? Why is it a good investment to invest into a mortgage investment corporation? Well, of course, the answer is the mortgages within a mortgage investment corporation are private mortgages. And this is an area, again, that can scare some people, can confuse some people. Maybe explain a little bit more about that specific space and exactly what a MIC is.
Sure. So the MIC entity was introduced by the government of Canada in the late 70s. At that time, there was I was born in the mid 70s, so just after I was born, this was introduced. But there was apparently a gap in the marketplace in terms of available lenders, and they wanted to introduce a new form of mortgage lending. What we really are today, if you fast forward, 4 years, is we fill a niche in the market that the big banks and the big credit unions and so on do not fill, and that is short-term lending. Short-term lending to somebody that has a more immediate need that maybe isn't a fit with the bank, and that could be for a whole host of reasons. And because we're short-term lenders, we therefore charge higher interest rates. If you look at what a bank or a credit union or a monoline trust company offers, they're offering a mortgage that you pay off over 25, 30 years. So they're collecting interest for all those years. Whereas we're in the mortgage investment corporation space, we're in the shorter term window, oftentimes 1 year, maybe up to a couple years. At AP Capital, Mick, we only offer 1 year term mortgages. So we're offering them at higher interest rates because of that shorter window of time that the money is out.
That makes total sense. So just tell me in quick terms, how big is that market? Okay, so we now have identified that there's a gap in the market between what the banks and trust companies and credit unions offer. There's short-term lending opportunities in the private space. In Canada, how big is that space today?
So CMHC, which is the insurance arm of the government for the insured portfolio, actually researched the MIC space, is regularly researching it. There's 30 entities, including AP Capital. Our firm reports to CMHC every quarter. So they published recently that in 2020, so last year, the total market was between 13 and 14 billion dollars in Canada.
Yeah, again, I think it's a very, personally, I've always thought that this was one of the most underutilized investment tools, mostly because a lot of people don't understand it. So I want to dive into, we've talked about the macro picture, what the mortgage industry space is, where companies like AP Capital play a role in that private niche market, which is a 13 to 14 billion dollar industry, if you will. So just help our listeners understand in layman's terms, if someone were to invest into AP Capital, how does that money work? How do you identify where that money is allocated, and how does it flow through as a return on your investment back to the investor?
So as a mortgage investment corporation, we are a pooled investment. So as investors choose to make allocation through a firm like yours, Peter, those funds arrive into our corporate pooled accounts, and we immediately look to place them in mortgages that are appropriate for our criteria. So to just take today, for instance, we sit on approximately 250 mortgages in our portfolio. So when a new investor becomes a shareholder in AP Capital MIC, they're immediately a shareholder of 250 mortgages. Now, when we go about making a selection for the next mortgage, our underwriting team is looking at files every day, and we receive those files through mortgage brokers. In a very similar way that Scotiabank or Van City would receive mortgages from mortgage brokers, we're receiving mortgage applications through mortgage brokers. And we can be very selective on the ones we like versus those that we say we're not interested. And we probably say we're not interested to 2 to 3 for every one that we say, this one might have some interest to us. And then our underwriting team essentially looks at a file in a very similar way as a major bank lender. And that is, we look at the property, we look at the borrower, and we're looking at everything from the valuation of the property to the covenant of the borrower, their credit, their income, and how they'll make their payments. But really, we're looking through both lenses. And if there's a difference, I think that difference is that we look heavily through the lens of the property that is our security. And so it's really that approach when we're dealing with investor capital that is a decision made day in and day out by our team.
And so again, how does the investor get a return? What happens there? So you've got a combination of first and second mortgages. They can be different interest rates. How does the money actually come back to the investor from an investor's perspective?
As we sit here today, kind of we'll call it post-pandemic, even though we're sort of towards the tail end of it in November 2021, we're lending out at a weighted average interest rate kind of in the mid sevens. We'll call it 7.5% approximately. Those rates are starting to edge upwards, but we're kind of in that interest rate environment right now, which I would say is the lowest we've seen for this type of niche lending in well over a decade. We've been operating at AP Capital now for over 13 years, and we've certainly not seen interest rates in our world at this rate for our history. So if we're lending out at 7.5%, we take a management fee for running the business of 1.5%. So just simple math, 7.5 minus 1.5, you're down to 6. There's a few extra costs to run the business, but really that 1.5 is to operate our business, which is a separate management company. So really you knock off a few more basis points and we get to sort of the high fives in terms of interest, in terms of return to the investor. as we sit here today. Also, just this very structure of the Mortgage Investment Corporation, the Canadian Tax Act requires us to pass through 100% of our net income. So when we're passing through 100% of our net income, that's going out to our investors.
After the management fee.
After the management fee. So think of it 7.5 minus 1.5 minus a little bit more, and you kind of get into those high fives in terms of return to investors. So as you know, we're sitting here today, we're getting lots of news in the market about rising interest rates next year. You know, we'll see that weighted average interest rate start to head towards 8.5 over the course of, you know, coming quarters. And that will then expected to realize in higher yield to investors.
Right. And for a lot of investors, this is something they might look to as an alternative to fixed income. So, for example, a traditional stocks and bonds portfolio would be weighted maybe 60% stocks, 40% bonds. Would it be safe? I know you can't really refer to this as a fixed income bond equivalent, but there are a lot of similarities. And I mean, one of the things is you're still a private company. There's a lack of liquidity there. We'll touch on that in a bit. But would it be fair to call this an alternative to a fixed income product?
I would look at it from the standpoint of how our current shareholders are looking at us. And I think that's a very fair assessment on your part. We have over 1,300 shareholders today in the fund. And many of them are looking at this as a way to preserve their capital, meaning they don't want to risk the volatility of a market where prices are rising or falling, and they have the anxiety or stress of watching their hard saved or earned money facing those types of fluctuations, and then just receiving steady return. And we've had, you know, today we're on the 1st of November here today, we made a distribution this morning, I believe is our 141st consecutive monthly distributions. And our net asset value has remained unchanged during that entire period. So, you know, all those things lead to what you're saying is that it starts to look a little bit like a fixed income or bond type alternative.
Well, Jess, you know, as I said, I personally think that is one of the most underutilized components of someone's portfolio. And the only reason it's not more widely utilized, in my opinion, is lack of knowledge or education out there in the industry. But I just want to touch on something you just said. 141 consecutive months of paying out a distribution. That's incredible. That's an incredible track record. I mean, think about that, folks. That's almost 12 straight years. When you think of an industry, the investment world, where there's so much volatility, AP's been able to pay out their dividend every month without skipping a beat for almost 12 consecutive years. What would you attribute that success to, Jess?
Well, I mean, I think that the real estate market in Canada has shown just an incredible resilience over the course of many decades. Canadians are keen to purchase a home or rent a home and live in it. And so as a lender in this market, we're looking at those elements and saying, hey, this is a very stable asset class. It has been historically. We truly believe that it will be going forward. And so we're looking at the value of a home and saying, okay, we're willing to lend up to, say, 70% of its value. And by doing so, we feel very strongly that the monthly payments will come in. And in the event of challenging borrowers, we will get our capital back, because we have a court system in this country that enforces people's payment requirements. And so the whole model of just look at Canadian banks. They've been strong performers over many, many decades as well. So really, at the end of the day, I think it's a combination of a very strong asset class in residential real estate and a culture in Canada where people make their mortgage payments.
Okay, so we've talked about the industry. And you mentioned it's a very strong market, and there's a reason why banks make a lot of money on lending out mortgages, et cetera. What about AP specifically? Now, there's you mentioned the MIC Managers Association that you're now president of. There's a lot of different MICs out there. Why would an investor be interested in investing into AP specifically? And on that note, I'll add one more stat. I think 99% of your mortgages are residential. So why is it that you steer away from commercial, raw land, development, and mortgages of that sort, and focus more on the residential side?
Yeah, I mean, I think probably like many businesses, you learn in those early years who you are. And I think in those very first 5 years, kind of between 2008, 2012, 13, 14, we were a lender on all types of residential real estate. And what we found was that we ended up with less headaches and more predictability in just traditional residential single detached homes in urban areas with good, marketable neighborhoods and so on. And so we started to do more of that. Now, it doesn't mean that we won't land on a piece of land when we see a great deal of value and we can loan to a low loan to value on that. So we feel very, very well protected. But we're not traditionally known as a lender of that style. We're not traditionally known as a lender that does construction mortgages. Mm-hmm. We also realize that if the market softens and a house is half built, it's pretty difficult to come in and start swinging the hammer when we come to an office downtown every day. Like, we're not builders. So we've really just looked at the market and said, okay, the residential detached home is our preference. We like that asset class. If you take the city of Vancouver, there's less single detached homes in the city of Vancouver every year for the last 20 years. Not more, less. Yeah. So we're talking about an asset in the city of Vancouver that actually is in a scarcity of supply as residential homes are being replaced by townhouses, multifamily condo projects, and so on. So we feel really good about, being a residential lender.
Excellent. And I think another thing that's really important, this is not a couple of guys in the back room making a decision on, let's lend money to Joe and let's lend money to Bob. You guys actually, aside from the fact that you run as a corporation, a very well-run, organized company, you also have an outside external advisory board. And I think that's really important for investors to understand and realize. Can you tell me a little bit about the advisory board and the role they play?
Sure. So like you mentioned, we run a going concern operation here. Come visit us downtown. We're in the Bentall 2 building. We have a team that operates the business alongside myself, and we're proud of the work that we do. Our underwriting team are very experienced outside of the mix space. In fact, the vast majority of them come from the big bank world. So they come from the banking, they wore banker hats as underwriters prior to coming over to AP Capital MIC. So, I think that speaks volumes when you're looking at investing in this type of an operation. You touch on our advisory board. As we grew and as we had some larger investors, they really wanted to have some independent eyes and ears on our business. Some of these families started to increase their positions. I think some of our largest families now are almost in excess of $10 million. Wow. We have many that are kind of between that $5 and $10 million range as family investments. And, they certainly have grown to have confidence in myself and my partners and the team as a whole, but they wanted to have some of that independent oversight and governance from an advisory board. So we've welcomed a member into that advisory board. His name is Terry Krepkevich. Terry's a very experienced former CFO for a public company. He works closely with our controller. He has a direct line of communication to our auditors at MNP, and really works very closely with us. He's the chairman of our board, in addition to being our independent advisory board. And it really is just, somebody that's outside of the ownership base that, again, is very much engaged with me and our executives to help steer us down the path.
I think that's really critical and important for, again, if you're watching this video as an investor, potential investor, it's really important for you to understand that this goes beyond just kind of a small little group of people that if you're worried about, what happens if I put my money into this private company, make this investment, and they take off to Tahiti tomorrow and I never see my money again. There's always that concern in the back chest. And I always like to say that one of the things that we do at Diversify is focus on quality investments for our clients that have institutional grade, institutional quality. I often will use that term But then when I look at you guys, and I think institutional quality, you've got, like you said, some families have put between $5 and $10 million into your fund. Again, investors can put $25,000 through their TFSA, their RSP, or cash. But you are also attracting some institutional bank grade investors. I don't know to what degree you can mention names, but tell me a little bit, just touch on it, how you're attracting institutional money as well.
I think it's a testament to our longevity and our consistency. We've been now operating for more than 13 years, consistently generating those returns we talked about. Today, 141st, I think I have that right. Maybe it's our 142nd monthly distribution to shareholders. And I think that, people have been watching us for some time. And I think that it's that longevity and consistency that has led to us having a very diverse investor base, from, like you mentioned, somebody with a TFSA all the way up to the families, and now institutional investors. We've had some endowment funds invest with us. We've had some discretionary portfolio managers that are choosing us as an allocation of their discretionary investment decision. And one thing that we haven't touched on that I think as an investor speaks volumes, in addition to the advisory board and the track record and so on, is we have a very, very strong relationship to our bank, which is RBC. So let me just speak to kind of this combination of equity, which is investors' funds, plus line of credit or available cash from RBC. So today we have a sizable line of credit of $50 million from RBC that we have the ability to use in addition to the investor capital. That gives us total lendable funds of just over $160 million. But the important element here is that RBC does not extend a substantial line of credit like this to just any and all mortgage investment corporations. In fact, they have very selective procedures in place as to how they offer this. To my knowledge, there's less than 5 in British Columbia that have an RBC line of credit. And the number is quite small even when you look across the country. So we're proud of that relationship. What it requires us to send them monthly reporting of our entire portfolio. They also do field exams where they come in and they actually just randomly pull files. We need to present them with all the elements of the file that they expect to see inside that file. So I think that if there's one thing that even gives a heightened level of confidence to an investor, it would be knowing that a big RBC is in here and very much engaged in our business on a monthly basis and on premise at least once or twice a year, seeing and really going through and understanding the portfolio mix.
I think that's actually critical. It actually was going to be my next question. So you answered it for me because, folks, you got to understand, RBC doesn't throw that type of money out there and extend lines of credit without doing a lot of due diligence. So as a potential investor, I can almost guarantee any question or concern you have about investing your capital, RBC's address that before they extended the line of credit as part of their due diligence. But Jess, I'm going to shift a little bit here. I just want to speak to what some of the risks or concerns to a potential investor would be, because whenever I'm out there and I'm talking to investors and I explain that, well, you can invest into a MIC. It's a mortgage investment corporation, and they lend money out to various borrowers who may not have qualified at the bank. And somebody will immediately say, whoa, time out. If this person didn't qualify for a mortgage at the bank, why would I want to be part of a pool of capital that's lending? Wouldn't that be risky? I mean, wouldn't there be a significant risk or fear of default if these individuals couldn't qualify at the bank and they're coming to you for money and they're paying higher interest rates, et cetera? So you can see there's that concern out there or fear that, wow, this has to be risky. Can you speak to that a little bit? Because I think that's a bit of a myth or misunderstood.
It is. And, I think that people, when they start to understand who the borrower is that comes to an AP Capital MIC, it's not who they initially sort of estimated it might be. There's many different types of Canadians, but when it comes to financial Canadians, there's Canadians that have income from their job and let's say they work in a job with, you know, six-figure income and it's consistent, and they got a T4 slip that, you know, is year over year, consistent. Maybe their spouse is also in that type of a working environment, you know, where the combined income is just this consistent job type environment. That is who the banks and large, credit unions and finance companies and so on are mostly conditioned for. There's another type of Canadian that maybe doesn't have consistent income. They maybe have high net worth. They maybe have corporate income and some personal. They're working with their accountant to determine how much they should show from a personal perspective, because really their business income is one that allows them to, you know, have that distribution of income to corporate versus personal. Sometimes they have lumpy income. One year they have a lot, next year they have very little, and just because of the nature of the business or the way in which they earn their income. So those types of Canadians actually find it quite challenging to work with our conventional banking system. And so with that comes the opportunity for lenders like us to provide them with a solution. And sometimes the higher interest rate is far less expensive to them than some of the other tax planning that they might go through with their accountant. Another one, which I think is one to be considerate of, is that, you know, if there's people that are locked into a fixed 5-year term mortgage, and to break that 5-year term mortgage has high interest penalties. And so even if they have consistent income and they're kind of a bank customer, they might have gotten themselves into that fixed 5-year mortgage, and now they want to maybe refinance or gain access to help their kids with a down payment, or expand their business, or pay out a spouse if they're going through a divorce. You know, there's all these different scenarios where somebody might need access to the equity in their home. And sometimes they're in a situation where they're actually in a better position to borrow from a lender like AP Capital than they would be to break the fixed term mortgage that they already have with their conventional bank. And then at some point, a year, maybe sometimes 2 years later, they can refinance with their conventional lender and be back on track. So really, the AP Capital solution to people is a short-term one. We're not there to help somebody pay off their home for 25 years. We're that short-term, interim sort of bridge financing solution to them.
I think that's the key, is people have to understand that you're not comparing this to a 25-year mortgage, 5-year term. It's a short Band-Aid solution, as I like to say, helping somebody go from point A to B. And again, as we've already mentioned, upwards of a $14 billion industry in Canada. So suffice to say, there might be that perception this is risky, but it's a big industry. One of the reasons I think people think it's risky is because someone who's borrowing private money has a bigger risk of going into default and foreclosure. Now, here's something interesting. When you say the word foreclosure or default on your mortgage, is a scary term. It's a dirty word out there. And that's something that can concern an investor as well. I look at it, and because I understand your industry and I know it, I realize that foreclosure is not a dirty word in your world. And I think it's important that we just touch on the fact that you might have a certain percentage, and it's almost guaranteed you're going to have a certain percentage, up to 5% at any given time, will go into foreclosure. But why is that not an issue for you, and particularly for potential investors?
You said it well there, Peter. I mean, it is the nature of our business to foreclose on borrowers that aren't making their payments or who can't make their payment at the time of maturity. We've done over 1,000 mortgages in our 13 years, well north of 1,000, and probably put 60 or 70 through foreclosure. Now, foreclosure, like you said, is not a dirty word in our world. It's sort of the last step in collecting on somebody that hasn't been able to resolve their situation. When we see somebody that's not able to make a payment, we're in communication with them immediately. I'm talking immediately. Like, we're pulling payments today, it's November 1st. And if we see any one of those payments NSF, tomorrow the phone is ringing. And we're discussing with them about the fact that the payment didn't go through and how are they going to make up that payment. And so we're chasing those borrowers and resolving, in almost all cases, we're resolving them. But for those that are repeatedly problematic, and maybe they miss the November 1st and then miss the December 1st, and they're not communicating in a way that helps us appreciate they're going to get back on track, then we have to go to the step of protecting our capital, investors' capital, and foreclosing. And thankfully in this country, we have good laws where the courts will give people some leeway. They definitely give them 3 to 6 months to kind of work out their problems. But after that, it's a court-martialed, so to speak, sale of the person's home where the debtors are paid, the realtors are paid, the legal experts are paid, and then the homeowner gets the remaining balance. So, the most important part to us is to make good lending decisions at the beginning. So we talk about loan to value, LTV is a shorter term for loan to value. And those are critical elements, because if we see a home and it's worth 1.5 and we're going to lend $1 million on a 1.5, so call it 66% loan to value, we feel confident that if that person defaults, we can work with them to resolve it, or foreclosure will lead to them having to sell it. And maybe 1.5 softens to 1.3, in a down market. But by the time the realtors and the lawyers are paid, we're getting all of our $1 million back. And the interest rate keeps clicking during all of those weeks or months that they're in foreclosure. So it's not as though we're not collecting the interest that's due to us contractually. So again, we don't love putting people in foreclosure, but it is certainly what we do, because we're here to take care of our investors' capital, and we make sure that people are fulfilling their obligation to us and making payments. And
you're not lending 100% financing. You're not going to 95% financing. It's like that's another really important component that people need to understand. Is like these aren't. Just because it's private doesn't mean that someone can borrow 100%. And if the market softens, you're at risk of losing capital. What's the average loan to value? Just real quick, I just want to be sensitive on our time here, but what's the average loan to value in your portfolio today?
So as we sit here in November, it's under 60%. I think we're at 57, 58% loan to value across 250 mortgages.
Right. And that's probably, again, why you focus on the residential side, because you do have to foreclose and your loan to value is below 75%, you're at 60%, then it's quite likely, even if it does take 6 to 10 months for the process to go through the courts, the capital is going to return back to the pool.
Correct.
Right. Okay. So, yeah, I think, again, to me, that's a very important thing for investors to understand in terms of providing an element of security for their investment. Let's talk on COVID. I mean, COVID, we've been going through a pandemic. I mean, we go back March 2020, a year and a half ago, you and I were talking, there was a big concern that suddenly these defaults would like skyrocket and how that may or may not impact your fund. 2 quick things. Tell me a little bit about how your management team managed the process through COVID, through the pandemic, what's come out the other side, and what surprised you the most?
Yeah, so at the beginning there in March of 2020, I remember it all too well, just saying to the team that I did not care if we had our lowest origination quarter in our history, meaning we were not trying to chase new deals in the very opening months. We wanted to double down on communication with our existing borrowers, helping them appreciate they must make their payments to us.
And Jess, the other thing I noticed in your fund, and this relates, I want you to touch just briefly on this, because you did reduce your yield from 7 down to 5.65%. But is that not a direct correlation to the fact that you had an increase in first mortgages throughout the pandemic?
Yeah, I would say it was a impact. So when we reduced our monthly distribution from 7 down to 5.65, so a 1.35% reduction in our distribution to shareholders, it was a combination of us choosing more conservative deals, like staying very disciplined. We definitely started to do more first versus second mortgages, but the true influence there was the fact that interest rates just were significantly lower than pre-pandemic. But it certainly reflected itself in our pricing in our industry by summer of last year. So we made some adjustments to our distributions because we weren't going to, again, using the Peter Kinch term, we weren't going to go out onto the skinny branches and do higher risk deals.
Yeah.
We wanted to remain disciplined, and therefore our yield dropped accordingly.
As a personal investor myself, I really appreciated that because there's a temptation out there to listen to the barking dogs, maintain the 7%, but to do that, you're going to take undue necessary risk potentially on those skinny branches. And as a personal investor, I'm glad you didn't. And just ensuring the safety and security of the capital, preservation capital first and foremost, return after that. Jess, wrapping up here, I just want to touch on two last questions here. Number one, we all know that there's risk associated with any investment. And this is a private investment, private company. It's not trading on a stock exchange. So if you change your mind tomorrow, you can't just push a button and get rid of the stock. But tell me, from your perspective, what do you see as the biggest headwinds or risks associated for a potential investor investing into your MIC?
Well, I think that if I look at what the composition of our current shareholders are, the 1,300 people we are custodians of their invested capital, from the $10,000 TFSA up to those families with $5-10 million, is that they actually believe in real estate, right? And so I think an investor needs to have a core belief that this asset class called real estate in Canada is a good one, and they feel confident and comfortable with it. Because to me, the risk of this investment is that we are advancing debt, mortgages, against the security being a home or a piece of real estate. So if there's a dramatic erosion and decline in the value of that home, and we've placed debt on that home, then we're putting that debt at risk if house prices were to decline dramatically in a short period of time.
Well, that's, I mean, when I do get people worried about risk or concern, they say, well, what if the entire market collapses? And I often say, well, if AP is lending out its average of 60% loan to value and it collapses beyond that, we probably have other issues and other problems. But so you touched on the risk. The last question I want to ask is a combination of why AP Capital on one hand, but also where do you see the opportunities when you, as the CEO of AP Capital Mortgage Investment Corporation, look out to 2022 and beyond? Where do you see the opportunities for your company and for investors?
Well, we see an opportunity just of consistently growing the book of business, increasing that diversification so that we, when an investor comes into our fund, that they know that their money is spread widely across residential real estate, because we see this market as being one that, even though it's maybe, between, it's single digit percentages of the total residential market, we see that as still being a very substantial market size in this country. So I mentioned earlier that across Canada, the MIC space is somewhere between that sort of $13 and $15 billion. We see plenty of room for AP Capital to continue to grow into that. And our investors will then receive that, diversification of a larger pool of funds spread across a larger number of mortgages. So if anything, I think we'll be more of a disciplined lender in the future, and just continually focusing on consistency of delivering results. Our track record is one we're very, very proud of, but we also realize that past performance does not guarantee future performance. So we have to continue to work hard every day, make good choices, hold borrowers to account on making their payments, looking for opportunities on new deals, and growing with companies like yourselves. So we appreciate everything you guys have done with us.
Well, Jess, thank you. Well put. I think it provides potential investors with a really good overview of not just your company, but the space of mortgage investment corps in general, and specifically why AP Capital, why we at Diversify are big supporters of you and your company. So listen, Jess, we could go on. You and I don't have any trouble filling up a lot of time to do Q&A and all that. But I just want to thank you very much, ladies and gentlemen. That's Jess Hagen, the CEO of AP Capital Mortgage Investment Corporation. Thanks for being a guest today. And folks, if you want more information, please contact us. You can go to our website, diversify.ca. It's Peter at diversify.ca. You can just reach out to us, contact us directly. More than happy to answer any questions. Jess, thanks very much. It was great talking to you today.
Thanks, Peter.
Okay, you take care. We'll talk soon.